Good day everyone, my name is Marcus,
And I'm Jimmy.
and if you're new to this channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription goes a long way in supporting our channel's production. Now before we dive into today's video, have a look at these financial disclaimers before we proceed. Now, in today's video we'll be talking about hedge funds. Hedge funds represent funds that can only take investments from accredited investors. In the US, an accredited investor is defined as a person or individual having a net worth of over 1 million US dollars and around 200,000 US dollars in annual salary. In the European Union, you need an investment portfolio greater than 500,000 euros to be qualified as an accredited investor. Whereas in Singapore, you need to have a net worth of over $2 million to attain this title. So, you have to see that the demographic that hedge funds are catering to are very niche and very specific. The reason behind this is because we have to understand the purpose of hedge funds first. Hedge funds do not aim to beat the market, they aim not to lose money. There's a very big difference, you have to understand that. So they aim not to lose money and to deliver returns that are uncorrelated to the market. If the market goes up by 5%, they aim to be 5% up after charging all the administration and management fees for handling their people's money. If the market crashes by 30%, they aim to lose less than 30%. It means you typically see lower returns but relatively safer to the markets. Hence, that's how the hedge in hedge funds comes about. Basically to insure yourself against wider market movements and corrections. Since their goal is not to lose money, you often see funds shorting bear markets to offset their losses in long positions. Again, for those of you who are not clear what shorting means, it basically means short selling or betting that the price goes down. Short sellers make money when the price of a company goes down to the level that they expect it to go down to. These positions usually come about by using leverage. Leverage is another concept that I'm sure many of you are unfamiliar with. It basically means having a system that allows you to bet more than what you have, and the amount of leverage differs from broker to broker. Anyway, back to hedge funds. Because of the huge amount of leverage they have and the massive amounts of short and long positions they have, if the market turns bullish, they are making money from their long positions and potentially losing money from their short positions. Either way, regardless of whether the market is up or down, they aim for their gains to be greater than their losses. And they hedge against their own positions so as to reduce the risk and fulfill the management criteria that they set out in their investment vision as well as the investment goals that they told the investors that are investing in their company.
So, why do people invest in hedge funds? It's the same reason why people invest in equities, and gold, and property, etc. They serve as a means of diversification, a safe bet. Some hedge funds do beat the market year on year, but they are usually a small minority of small funds. Much easier to scale small amounts of money.
I see that hedge funds, most of them, they maintain very big positions, but this also means that they stand a lot to lose. The next popular question is, so why do fund managers make so much? Now, to answer this question, we have to understand that hedge funds are typically private entities. They do not have an obligation to share any of their high-profile strategies or the accumulated wealth in their accounts with anyone. Some of these strategies can be really high-tech, such as using algorithmic trading or using computers that have fiber cables that calculate numbers up to 14 milliseconds. Funds publicly declare a 3% return in their filings, such as the SEC 10K, the SEC 8K, but they could be making 50% and taking 47% in administrative fees. So this is why you see hedge fund managers pocketing so much money, because most of their money actually comes from the people who invest into their company. And to understand these administrative fees, they are charged whenever an investor puts money into the company, and the longer the investor leaves the money there, the more administrative fees will be charged to the investor in the long run. This means that regardless of whether the hedge fund manager produces positive or negative returns for the investor, he is still getting profit because of the massive administrative fees he is collecting from his customer base. That said, the converse also applies. They could declare 3% but in reality might be losing 20% every year. Another reason why fund managers make so much is because they have insane economies of scale. Their assets under management, short form AUM, which is a term commonly used in the hedge fund market, is usually a huge figure in hundreds of millions to billions. Take the example of ARK Investment CEO who manages 180 billion under herself, or the famous billionaire investor Ray Dalio who manages many billions, I can't even count. So 1% of 1 billion is 10 million. And depending on the funds, typical fees look like 0.5 to 2% of management fees on assets plus 20% of returns. If you want to know some of the most successful private funds in the market, I definitely have one for you. Check out Renaissance Technologies, or short form Rentec. Their in-house fund, which is only available to current and past employers and not to the public, averaged 71.8% annual return before fees from 1994 to 2014. That's crazy. The S&P 500 only manages to grow by 8 to 10% every year, so they're beating the market by close to 7 times. They're only up 24% this year to date, but that is very, very impressive already. That said, they are wholly private and no one can verify that it's true. But the fact that they can continue to attract the best researchers, the best mathematicians and statisticians from the greatest universities in the world speaks volumes for the company.
This hedge fund move is not inconsistent with the current move in other markets. Hedge funds seem to be expecting that the US market is going to begin to decline once again and have already begun to position themselves for such a fall. Attitudes have changed over the past 10 days as investors appear to now believe that the Federal Reserve will not continue to dominate in the future. The concerns of hedge fund managers have already had an impact on foreign exchange markets, as the value of the US dollar has been decreasing for the past 10 days. Since the killing in Minnesota and photo op in Washington DC, investors and traders have lost confidence in the US to deal with the first two issues just mentioned. As Stephen Alanger writes in the New York Times, with American cities burning and the coronavirus still raging, killing more people than in any other country, President Donald Trump also has growing problems overseas. He has never before been so isolated and ignored, even mocked. This has been the last straw that seemingly has impacted trading in the dollar.
Now on to other news this week. Tesla ticker symbol TSLA CEO Elon Musk, in a reply on Twitter, called for Amazon to be broken up, noting that monopolies are wrong. The tweet comes days after the entrepreneur said he was off Twitter for a while, and was in response to an email image of Amazon's restriction on a book that discussed the COVID-19 pandemic. CNBC in a segment highlighted the animosity that may potentially exist between Elon and Amazon's CEO Jeff Bezos, not to mention their competing interests in space, with the latter's company Blue Origin also building reusable space rockets to launch to space. Amazon also invested in Rivian, an electric vehicle manufacturer. The Wall Street Journal in late May also published a story noting that Amazon was in discussions to buy a driverless technology startup named Zoox. So you can see from all their actions, it is very obvious who they are taking after. The tweet also comes at a time of increased regulatory scrutiny for some of the largest tech names. Wedbush Dan Ives called it a storm cloud, and many have likened it to a witch hunt trying to bring down some of the biggest tech companies on the Nasdaq. But either way, no matter what Bezos and the financial media have to say about Tesla, there's no denying that they're absolutely ripping it this past few weeks. Whether it's Robinhood millennials or grizzled portfolio managers, the Tesla break to 4 digits could draw in even more attention to players in the electric vehicle market, such as Nikola, Achimoto, Electra Mechania Vehicles, and many others. On the flip side, because of the rise in electrification and the fact that the customer base is growing by millions day by day, traditional automaker companies such as Ford, General Motors, and Volkswagen are pushing ahead with their electrification plans and intend to double their volume in these few coming months.
Moments later, Elon Musk lent support to Jack Dorsey, saying, "Jack is doing his best, I support him," a reply to an individual critiquing Twitter and asking Musk to create a social site.
Now we have come to the end of this video, and I hope that this video has enlightened you on the workings of hedge funds as well as given you a brief idea of how they can influence the market with all the massive portfolios they have. If you're a trader, knowing when the institutions invest in a stock is a great time to take a position because you know that you have almost unlimited money supporting the stock, and you definitely don't want to take a position against them because that is definitely a sign for trouble. I've attached some links to the channels below which I took reference from, and I'll be flattered if you have one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and I'll try my best to answer all of them thoroughly. Stay tuned for the next video and invest safe.
Ever since the day that you